Hello everybody, this is a video lesson about a principle in international economics called the balance of payments. So the balance of payments, otherwise abbreviated as BOP, is an accounting system. What does that mean? It means to measure the money that is coming in versus going out. So it's an accounting system to keep track of the transactions between countries over a period of time. It is made up of two accounts, the current account and what's called the capital and financial account. Now, I'm making this video in 2025, and one of the things that you should know is that this second account, capital and financial account, has gone through a little bit of a naming identity crisis. There have been times that I've been teaching this course where we've called it the financial account. There have been times when we've only called it the capital account. And now it seems in the last year or so, maybe 2 years, College Board is referring to it as its name that other macroeconomists call it, which is capital and financial account. So if you see other names out there, don't panic. That's okay. But we're going to call it the capital and financial account, and sometimes just the CFA for short. Couple of key things to keep track of before we take a few more notes on what these two accounts are is that terms that you should know. We're going to be using the terms debit and credit. So debit means money that is leaving. So if you were to use a debit card, that means that you would use that to purchase an item and money would be leaving your account. So that you should be able to relate to from personal experience. Credit is a money coming in. So, for example, if you were to return something that you bought, a store would give you a credit, meaning that money would come back into your hands instead of the item. The other thing to think about is that these two counts are what we call in opposition to one another, almost like a yin and a yang. So when the current account is in what we call a deficit, maybe more money's leaving the country than coming in, then the CFA would be in a surplus. So the vocabulary there is similar to when we talk about budgets. We're talking about deficits and surpluses as opposed to increases or decreases. And the last thing that sort of piggybacks on that concept of opposition is the fact that these two accounts are what we call they balance one another. So when you add the two amounts together, they should equal zero. So if one account is in a $200 million deficit, then that means that the other one would be in a $200 million surplus. And if you add those two together, you would have zero. So what I'd like you to do right now is to make a little T-chart for the balance of payments. And on the left-hand side, we'll put the current account, and on the right-hand side, we'll do the capital and financial account. I'd like to give you a couple examples as I go. Some of those examples will not be written on the screen, but the topics that they would be under would be on the screen. So as you are listening, please do not write down just the words you see on the screen, but maybe some of the examples that I'm providing as well. So if we start with the current account, I like to think of the current account as the trade account. This is where our balance of trade is going to come in, all of the things that we import and export from other parts of the country. Sorry, the world. So when we studied Unit 2, we learned about net exports for the first time. And net exports is when we take our exports and we subtract the imports. So that would be the dollar amount. How much money are we earning from our exports, subtracting the amount of money that we are losing from imports? And this number can be a negative number or a positive number, and it reflects our trade balance. So if we are exporting more than we're importing, then we would have a trade surplus, and vice versa. If we are importing more than we're exporting, we would have what's called a trade deficit. The next type of transaction that you're going to see in the current account are money transfers. So this is when people send money across country borders. So for example, let's say you were studying abroad in college and you went to a university in London and your parents sent you some money for spending money while you were in London. So when those dollars leave the United States, you get them in London. Of course, you would change them to that country's currency so that way you could actually use them as a medium of exchange. But again, that money that's leaving the country would be counted in money transfers. This is also true if you were traveling and you were taking American dollars out of the country with you to change into a foreign nation's currency when you arrive. Another example that could go in the current account is something that we call investment income. So that's exactly what it says. It's just the income that people make off of their investments. So again, let's say you were an American business person and you owned a chain of stores and you decided to open a shop in Paris. So you live in the United States, your company's based out of here, but when all those profits come in, they're coming out of France and into the United States. So similar to net exports, we're going to subtract all of the money transfers and investment income that's coming in from all of the money transfers and investment income that's going out. So sometimes you'll see the word net in front of those as well. Last but not least is something that when we say it out loud, we think, oh yeah, that happens all the time, but maybe we forget that it is something that matters when we think about money and goods and services that are leaving the country, and we call it unilateral transfers. This would be an example of any time the United States is going to provide aid for another country, supplies, ammunition. Maybe there's a business that has leftover items, and rather than sell them, they say, okay, we have all these extra t-shirts for the losing team in the Super Bowl. So instead of destroying those, we're going to take those t-shirts and we're going to donate them to a developing country that needs clothing. So despite the fact that there's no payment changing hands there are goods and services and or things of value that are moving in and out of the country. So we call those unilateral transfers. Shifting over to the right, the capital and financial account. So this is the account that's much more about investments and making money. It's sort of about assets as opposed to tangible things like dollars or items that are moving across the country's borders. So when we talk about the capital and financial account, sometimes you'll hear the word capital inflow or capital outflow. And the words inflow and outflow mean exactly what they imply. So this is about money that's flowing in or flowing out. So the first category would be any sort of financial asset that bears interest or profit. So what I have listed in the parentheses are things like stocks in another company, a bond, perhaps a foreigner invests in an American treasury bond or puts their money in an American bank account, like a certificate of deposit. That's what CD stands for there. Or any other sort of interest-bearing asset. So anytime that's occurring, we're going to keep track of those dollars coming in or going out of the US on the capital and financial account. Another example would be the purchase or sale of physical assets. So if I was a business person that moved to another or went to another nation and said, I'm going to buy this shopping mall, that's a physical asset. And then when I earn money off of it, I'm going to earn my investment income off of that physical asset, let's say. So sometimes that physical asset that I've purchased is going to provide a continuous source of income. So the initial purchase is going to be over here on the CFA, but the profit I earn off of it is going to come in over here on the current account. Last but not least, it's foreign direct investment. So this would be an example not of me buying something that already exists, but me actually constructing something in another country. So let's say I was the McDonald's Corporation and I was going to build a McDonald's, in some little town in Ireland. I have to pay a construction company. I maybe have to get permits. I have to do all the things that I would have to do to build a physical building in another place. And that's what foreign direct investment is. So these are really interesting financial moves that happen across country lines, and we keep track of them in something called the CFA. So these are the two accounts, and I just want to show you some examples. So let me use the example of Starbucks as a company, and then we can come up with a few examples that are custom to that company. So, an example of net exports for Starbucks would be, for example, if they imported coffee beans from Colombia. That's going to be a debit for the United States, and it's going to put our current account into a deficit because the money is leaving the US and goods are coming in. Let's look at a money transfer. Imagine somebody's working at a Starbucks while, attending college in the United States, and they send part of that paycheck home to their family in France. That is a debit for the US because it's money leaving the country. Investment income. This would be a credit for the United States. So imagine Starbucks having a store in Europe and then sending the profits back to their headquarters in Seattle. A unilateral transfer. Remember those things that are moving back and forth in between countries, goods and services or dollars, and they're not really compensated. It's a lot of times it's charity, it's assistance, it's aid, it's international cooperation between governments or private entities. So let's say that Starbucks had a lot of unsold inventory. So rather than throw it away, if there were things that were still, not expired, but good, perhaps let's say Starbucks decided to change the label on a particular product. So rather than throw out all the items with the old labels, what if they partnered with a school in Honduras and sent those items to that school? That would be a unilateral transfer. Now, if we look at the capital and financial account, when we look at some of these capital investments abroad, these asset transfers or trademarks, land rights, debt cancellation, any sort of interest-bearing account. For example, this didn't happen, but I'm just trying to give you a hypothetical. Let's say there's a Canadian soda company that, people really love the so-called pink drink. That's a trademarked name in the United States for Starbucks. And the soda company said, we'd love to sell a soda that's modeled after your pink drink. So if Starbucks allows them to purchase that name for their product, that would be money, that would be a credit for the US coming in. The next example would be, for example, if Starbucks sold the rights for somebody to use their classic siren logo on an item that they were selling in another country. Financial investments are things that continue to gain sort of an income. So these would be all of the different investments that people generate profits with. So for example, if Starbucks builds that new roasting plant in Vietnam, this is that foreign direct investment, and they're able to earn money off of that repeatedly. Or maybe they have a German investor who decides to buy $5 million worth of Starbucks stock. That's going to be a credit coming into the United States, and that's an example of a financial investment for the balance of payments. So coming back to the beginning, the balance of payments is an accounting system that keeps track of the transactions between countries over a period of time. We typically do it year by year. And when you think about these two accounts, you have the current account, which I, again, like to say it's more tangible items, it's actual currency and or goods and services moving across country borders. Whereas the CFA, the capital and financial account, is more about financial benefits that are moving across borders. So investments in banking opportunities, buying stocks, investing in treasury bonds, buying the rights to a certain trademark name or perhaps a license. Or maybe there's an individual or a company that's building a business abroad and they have more locations in another nation, or they decide that they're going to buy an existing investment like a hotel in another nation and then receive the profits coming back. The big things I want you to remember in addition to that are in this green box on the side, which is that when we add these two accounts together, because they're in opposition to one another, one account will always be in a deficit, whereas the other account is going to be in a surplus. So therefore, when you add the two numbers together, if you're given numbers, they should add up to zero. So a lot of times you'll get a free response question or a multiple choice question, and it will say things like, the United States capital account the United States current account with Switzerland is currently zero. And then it will give you, for example, a few transactions that happen, and then you have to determine if the current account moves into a surplus or a deficit. Sometimes you then have to think about what happens to the opposing account. So maybe you have a question that shows that there's going to be more imports into the United States. So if our current account moves into a deficit, then our CFA would move into a surplus. So when we come back together in class and we try some actual concrete examples in free response questions with that level of context, you'll know what to do if you can remember, again, that these accounts are in opposition. We speak about them as being in a deficit or a surplus, and when we add the numbers together, they equal 0.